we have William Lee, the Chief Economist, Global Economic Advisors of Global Economic Advisors, to throw some more light on the overall Fed policy amongst others. William, welcome to the show, and very good morning, very good afternoon to you as well. It's Puneet this side. Thanks so much for joining in this morning. Largely, not too many surprises, right, in terms of the outcome of what the Fed decision is. What were some of the key highlights that you found very interesting in last night's statement, as well as what came out of the Fed meet as well?
Well, thank you very much for having me on the show. But one of the things I want to point out to your audience is that even though the outcome was completely expected, no one was expecting the Fed to do anything, the statement and the press conference really highlighted a jarring paradox that's in the U.S. economy. We have a very rapidly growing economy, and yet the labor market itself is barely making jobs. And I think that paradox is a question that the Fed really has to consider as whether or not it can fulfill maximum employment mandate as well as price stability. Chair Powell made it very clear that inflation is subsiding. The bulge of the inflation has come from the tariffs that are expected to work its way through the economy by mid-year and taper off thereafter. Whereas the high productivity that has been in place is something that will continue to hold back job growth going forward for quite a while. That's because if a worker is more productive, a company is going to be less reluctant, less willing to hire extra workers. So in that kind of a situation where you have a secular case of labor market weakness and a transitory declining inflation in the future, I think it's very obvious why we had two dissents, because the two governors have felt that, well, since there's a lag in monetary policy, the action that should be taking place now is to lower rates to the low end of neutral, to boost up the interest-sensitive sectors, to be able to create more jobs to offset that secular decline in the demand for labor. So to me, those are the highlights that the press really has not picked up on. And while there's a lot of discussion about Fed independence, we can discuss that in a moment, the main point for Fed policy is the timing of when rate increases or rate cuts are supposed to be put in place. The lags in monetary policy are 6 months to 18 months. So we need to worry about the economy in the future. And in the future, with inflation waning, the big problem is going to be the labor market.
And William, you raise a key point on the independence of the Fed, and we'll come to that in just a bit. But largely, is it that you sit in the camp that in terms of job growth, which has been quite lenient, and the labor market participation that has been quite weak, you feel that there was less impetus put in this particular policy meet on that aspect rather than focusing on inflation and the control of the same, and hence, in terms of the dissent made by two Fed members, you would be in that camp that has to be more focus on rate cuts for job growth going forward?
Well, the committee is in a tough position, and many of them don't want to feel that they would lower rates now because people would accuse them of being at the bid of the president. And so I think even if committee members believe my argument, and more of them believe my argument and would have voted to cut rates, I think the political overhang put a damper on that kind of a vote. I don't think anyone would disagree that there's a secular case of softness in the job market, and the inflation is at best cyclical and transitory. Everyone agrees with that. Chair Powell agrees with that. So to me, the overhang of the politics of independence is delaying the needed vote to lower rates sooner rather than later.
William, as we wrap up this conversation, because of paucity of time, I have to get your views on what you think of in terms of Fed independence, because you did raise a key point, right? That if you cut the rates right now, even if you believe in it, it will feel like you are coming at the behest of the president. So how do you see the Fed's independence? And because the expectation now largely being that any cuts, if any, could only come in June, is that the expectation that you have as well?
I think the independence issue is a red herring because the Chair Powell is right now being accused of not being a good manager. There is no one, including Donald Trump and Secretary Bessent, who would say that they want to have influence on monetary policy itself. Although the president says, "I would rather have lower rates than higher rates." Now, every president's always said that. The actual charges that have been laid on the Fed is mission overcreep, right? They've extended beyond what they should be doing. They're doing more than just monetary policy and bank supervision. They've extended their research into climate change, into DEI issues. The budget of the Fed has quadrupled over the last 20 years, which is a much faster increase than the federal government budget, much faster increase than CPI. So that kind of administrative accountability is what's on the line right now. No one, including anyone in the administration, is saying that they want to haul back Fed independence on monetary policy. What they're trying to do is put in place Fed accountability on how they're using their money.
Got the view, William. But, William, thank you so much for coming in this morning, helping us with a few views before the market starts. We appreciate your time here on NDTV Profit. Always look forward to our next conversation.
Thanks for having me.
Thank you.